And I'm going to share real quick as well, just since we're on this topic. This is a hard thing sometimes to visually conceptualize. So I think if we were to go,
and as you're pulling that up, one of the things you said, Adam, about rents being sticky, guys, look backwards. Rents, not only do they not follow interest rates as far as when they go back down, but they don't follow what happens to the real estate market much either. When you look back when things crashed in 2008, 9, 10, and that whole mess, rents went up. Why did they go up? Because when the market does that in the real estate world, people still have to have a place to live, right? And as a result of that, and then because of that crash, builders stopped building. People lost jobs. Builders completely shut things down. Now look what we've got. Not only the builders shut down, they finally get some steam behind them. They start building, but now we have a supply chain crunch, right? So we're not going to catch up with the demand of housing. Therefore, rents are going to continue to climb. Now, this 30% crap that that's happening in these apartment complexes, I think it's immoral personally. To charge people 30% increases year over year is insanity to me. And I think it's going to come back and bite somebody in the ass. I hope it does. But I believe that anywhere from 5, 6, 7% doesn't, to me, that's not immoral. We're seeing that going up in inflation. Why are we not seeing that in other things?
Yeah. 100%. Adam, I can't share screen. I guess Google Chrome has a lock on it. Can you bring up our calculator on our computer on your screen under tools to show people where to go to that? Because we actually added something else in where they can plan or track their equity growth, factoring in whatever appreciation they want. It has an amortization scale, so you've got your debt reduction, and then also factoring in rent increases. I think that's a very conceptual tool to look at. It's a download from our website, renttoretirement.com, and then go to tools, more in tools, and then you can look at that. That has a pro forma, but also it shows that equity growth over time.
Yeah, I'm on my way. I will get that pulled up in just a minute. But Aaron, how long do you see? You mentioned sevens being hard. Do you see us getting into double digits at some point?
I honestly don't. I think that it should go there. I mean, really, if a person's going to lend money out for any length of time and expect to get a return on investment, it should go there, but I don't know that it will, because there's just way too much manipulation going on from the government side and from the side of the Fed that I believe they're going to keep that from happening. But then again, look at all the stupid crap that's gone on anyway. So I mean, it could. I don't believe that anybody. Let's just put it this way. I think this inflation was very, very highly preventable. But when you have the ability to just throw money around like crazy, you're not going to be around to see the ramifications. What do you care? So there is a solid possibility we could see that double-digit percentages again. And people still made money. In fact, the guy who handles a lot of my interest rate locks today, Scotty Bear, he's on the phone with everybody. He was investing in the early 80s. He paid 14%, and he still did fine. And property values were not going up as fast. Rents were not going up as fast, and he still did very, very well at 14%.
Yes, it's a relative point in time, and looking at all the data. But the main point is you're still taking action. You're still investing. I mean, what other advice you've gone through a lot of concrete data with us, Aaron, showing the numbers, and I think that's a lot of people may have to go back and listen through this and actually put pencil to paper with their calculator and draw it out, which is good practice to really understand it. But I mean, what other just in general advice do you have for people that are concerned about interest rates that might be preventing them from buying a property that they were used to seeing 4%, 4.5%, and now the cash flow is slightly less, and they're really just sitting on the sidelines because of that?
Well, I got three things that I need to point out. One is sitting on the sidelines is a lot like, would say, kind of like a star football player sitting on the bench waiting for that conserving energy to get on the field when there's the perfect play to get on the highlight reel. But what we find out is the only people on the highlight reel already have their ass on the field. So if you're not already out there playing and looking for the deals and understanding what is a deal, right? We have to understand that first. It's not all about the cash flow. Then you're not going to get on the highlight reel. You're not going to have that story to tell. The other thing is there's a lot of folks that are getting they're having a hard time because they're waiting for these rehabs to get done. Their rehabs are not getting done fast enough because we have supply chain issues, and therefore rates are going up and costs are going up. And it's like, well, if they're not going to pay for my rate going up because they're not getting done fast enough, I'm walking away. What they're failing to realize is their proper value probably jumped 20,000 in the period of time that they sat there and waited. Well, they're going to probably see an interest rate go up a quarter, maybe 3x in the cost, because there are points right now. I mean, to get somebody to give money for 30 years, you're going to pay points. They may pay a point or two, right, for that interest rate. they're thinking I'm wasting this money over here, but they're actually walking away from quadruple that revenue that's already built into the equity of the house that they signed that contract on. They're failing to see all of the different things. They're so hyper focused on the one thing. And they've been hyper focused on that because the banking industry has made them hyper focused. I don't know if we have time to get into that, but that is something the banking industry wins when they're hyper focused on interest rate. And that's something I get into some pretty good detail on to share that. But the next bit of advice that I want to share with people is, since you're going to be running calculators and you're going to be trying to figure out what is a good deal, what's not a good deal, and all that stuff. Well, here's a calculator you need to add to your arsenal. You need to get your phone out, right, and hit this QR code right now and get this. You have to fill in probably 3 bits of data: name, email address, phone number, and you'll get the calculator I just showed you to be able to show you how inflation is eroding that payment, give you a little bit more confidence in what you do. So you get the calculator, you'll get it when it comes in. You're going to be able to install that thing. It's going to look like this. It's called the QJO investment tool. Why is it called that? It's the quit jerking off investment tool, because that's all people are doing when they're wasting time trying to figure out how to get into a deal when they should have all the tools at their fingertips to get them there. So when you get there, you'll have 4 calculators. They're all helpful for real estate investors. This one we're going to talk about today is the mortgage amortization schedule. You click on that. You type in down payment, purchase price, and your interest rate, and you can play with that. Don't put in an additional payment. Any more money you give the lender, you're paying it back at today's dollar value. Well, it's worth more. Keep that for yourself. Hit the calculate button. You'll be able to see what your payment's going to be. You're going to see what your loan balance is as you scroll down. Go up here to the upper right-hand corner. Scroll to the right, because this is the first year. It'll give you all 30 years. So we're going to scroll to the right to the 30th year, 2052. Hit select and close. Then scroll down. Now you can see total payments over that time and inflation adjusted payments, meaning what you're really paying after inflation erodes a dollar. The other thing is cool here. We show your total payment, $719, but it's equivalent. So in 30 years, you'll spend $719 to get $65 worth of stuff that you could have bought today with $65. That's the big contrast in how the dollar's value is. So again, if you haven't gotten it, get the damn QR code out. If you need it, email me, go to my website, email me. We'll get it emailed to you so you get the access to this calculator.
All right. So, Zach, I've got...
well, Aaron just put us to shame with his calculator. So but we don't have anything to compare and contrast with inflation. But I think for this purpose, just simply so people know, just also to watch how equity grows year after year. That was really the sole purpose of this one. And we are building this out to be, this is just the formatting aspect of it in spreadsheet. But Adam, if you go down to one of the tabs where it says Wealth Tracker, so you punch in here, this is your normal pro forma that you put in your, mortgage, the interest rate, the rent, the tax, insurance, whatever amount you want to run for vacancy, maintenance, and so on. But if you go to the Wealth Tracker, this is where I think this helps people conceptualize just how much they're growing their net worth over time, regardless of cash flow, but also factoring in that rents go up over time. So at the very top, you can adjust whatever appreciation amount that you want to. In the highlighted box, you can put in, we have a 5% appreciation. Obviously, right now in most markets, we're seeing double that or significantly higher. You can also put in rental increases. In Aaron's example, we use 3%. That's a super safe number to use, and that compounds over time. So it just goes to show you year 2, 3, 4, 5, where you're actually at in your annual cash flow due to rental increases, as well as your overall equity position. And your equity position takes into consideration both whatever appreciation number you run at the top, and you can be very conservative with that. It's quite amazing, even with a small appreciation, how much equity you're growing. And it also takes into consideration your loan balance as that's being paid off. On the next tab is same thing, an amortization scale where you can see year after year. But that calculation is automatically ran in there. So definitely something to play around with and see if, just kind of help you conceptualize, okay, even if cash flows today on your pro forma slightly less because the interest rate is higher, where are you 5 years down the road, both in a cash flow position from rental increases and overall equity position? I mean, that's really the most important thing about investing in real estate, not even talking about the tax benefit side, because that's how people grow and compound net worth year after year and create generational wealth. You guys agree?
100%.
Absolutely.
100%.
Absolutely. Aaron, it looks like you pulled something else up on your calculator. Do you want to go to that?
I queued something up for you guys because since we talked about it, I might as well throw it out there. So I mentioned how interest rates, how the banking industry benefits when people zero in on interest rates being their main thing. And what I've noticed over my career, I've been doing this since 1997. It seems like every 4 to 5 years, you're getting those email, those commercials and those calls from the Dytex of the world saying now's the time to refi, right? Well, if it's every 4 to 5 years, I decided to take a look at an amortization schedule. So in this is an actual example of a deal that actually came through. The guy had a $120,000 loan. He had been paying on it for 4 years, approximately 4 years. It's a little bit off of that when you get to the real deal. But when you add this up, paid $719.46 a month for the entire 4 years. And then he paid his balance down from $119,000 to $113,000, only about $6,000 and change. So I'll fast forward, I'll advance this. Started with $120,000. Total payments for 48 months was $34,524 he paid. But this was what the principal reduction was, $6,400, right? And then he gets a call saying, now's a great time to refi because your rates are lower. Well, what did he do? He went ahead and refied. So I put this calculator here so you can see how I added things up so you can see that my math is correct. What he did is he went ahead and refied. He had a $114,000 balance at the time. He had $2,400 in taxes and insurance prepaid items plus $2,700 in costs. The lender, of course, convinced him to add that back into his loan. Where's his balance at now? $119,833. What did he start with? $120,000. So 4 years of payments, $34,000 in payments. They refinanced him. They shoved him right back into practically the loan amount he started at, and he starts over with those interest-heavy payments. So if you take a situation like this, you have a person in this scenario after 20 years of doing that, where's he at 20 years from now?
Same position.
He's in the exact same position. $118,000, $119,000 owed. But what if he was the guy down the street who bought on the same day, same price, same floor plan, had the same payment, but never refinanced? That guy has less than a third of his balance left. So what
this is coming from you on the lending side, who is incentivized for people to do more loans, right? I think that's important to know.
When the interest rates go down and people start calling me and say, hey, I've got all these people sending me emails and I haven't heard from you guys. I say, there's a reason why. And I spend more time when the rates drop. I think Adam can attest to this because I probably talked him out of a couple. But when the rates drop, I spend more time talking people out of refinances for rate and term than anything. It's amazing how much time me and my team spend just talking people out of it. If you're going to refinance, do it with cash out. Take that cash, invest it somewhere. Never do it for rate. The banking industry enslaves you into that interest payment if you go just for rate. Look at that. 20 years from now, he's never really gotten anywhere. He continues to owe the same amount. And he's just pinwheeled out this interest on these loans. It's a great big secret. Everybody says, well, if you're telling me that the banks never really make any money, and your example, that $80,000 loan, they only pay $69,000 back, why would the lenders give me a 30-year fixed? Because they don't intend you to keep it. Yeah. They psychologically have imprinted in you to make interest rate the most important thing in the deal. And then they incentivize the loan originators in my space to go out there and continue to get you to do that deal because it's free money. Why would they not do it? Right. And I fight to never do those. I think it's a waste and I think that it's immoral and I won't do it. Well, unless they make me do it, because by the law says I have to do it if somebody forces me to.
Yeah. Now I will say I have never come to you and asked for a refi due to rate. I've only refied to pull out money.
Just making sure. We've done a ton of business together and I'm not sure if we had that, but figured, hey, if I had somebody sitting here that I could call out and say that, then I would.
Yeah. There's a time. Obviously, like as you mentioned, it makes sense. If you're at a point where you have enough equity and there's other things you can do, right? You can just sell the property in 1031. You can potentially
100%.
look at HELOC opportunities but arbitrarily refinancing. That is a story we just hear about all the time and people loved it. It's almost a bragging point, right? It's like, oh, I got this rate. Yep. Well, what about all the equity that you just gave up and restarting your interest clock? So now that, yes, your payments $100 lower, but it's also significantly more interest and you're not paying any more principal. But it's just not the investor mindset.
Bragging rights. It's amazing how nobody really looks at the cost of bragging rights. The same reason you got the guy down the street running around a Ferrari and whatever. It's all about the bragging rights. He doesn't get there any any differently than somebody else, just a little bit more style, right? The other thing when it comes to that, I have had a lot of people argue with me, well, what if the interest rates go to zero? Well, then fine, right? I mean, we'd all would like to put 0% interest rate on our headstone. That makes sense.
Good luck.
Outside of that, right? That doesn't make sense to refinance unless it's just some ridiculously low rate that you just want to put on your headstone. I got 1% on my investment property.
And we digress a little bit as we get into this, but I mean, big picture, we're going back to where we're at now. Interest rates, it's a volatile space. Yes, we're seeing an increase in interest rates and probably still some. But big picture, it's just a metric in time and something that you need to look at on how you, all things from a global picture, what else are you doing with your money? If you're not buying an investment property, is that going to sit in a bank where inflation is just going to eat away at you? How can you use inflation as a tool? I mean, one of my biggest mentors always told me that your best mitigation against inflation is real estate, but even more so than that is debt, for all the points that you just mentioned, Aaron. So it's just about understanding it and knowing that, yes, cash flow day one might be a little bit affected, but look what you're doing from a global financial picture and actually running out the numbers 2, 3 year, 4 years down the road, not waiting out for this perfect environment where interest rates, are just at a point where you can cash flow more because there's so much more that you're missing in that. I think so.
Well, the psychological effect of getting yourself in a position to not be okay with having your bank balance low and having that money tied up in investments that you don't see the dollar value immediately. You have to actually conceptualize it in a spreadsheet or something to that effect. That's a hard thing for people to wrap their head around. That's very difficult for you to pull cash out and put it somewhere where you're not seeing it readily available to you. And that's a whole other thing that I get into with all the other strategies that I use. But, you guys have talked about the infinite banking strategy. I absolutely love it, but it's hard not to see it there. But just know that the longer it sits in your bank account, not being utilized to buy that property, even if you're paying costs more than you would be at any other time, even though the rate's going up, you're losing that more. You're losing that faster sitting in your bank account, pinwheeling at an 8.25%, in actuality, 16% loss, which is more than 1% per month. When you could have just put that money to work in the market, and you would have made that back by just within about a year to 2 years by taking it out of your bank account.
Yeah, love it. Absolutely love it. Aaron, is there anything else you want to touch on before we wrap it up today?
Not without opening up another hour of the conversation, because I got a lot of crap running around in here. That I was like, if I say that one sentence, we're screwed. We're going to go for a while.
We'll just have to have you back on, Aaron. You're always a wealth of knowledge, and I think just a reality check, right? From a lender perspective, from a professional investor perspective, of someone who's been in the game, who's been successful in the game, and completely understands it. It's important for people to kind of see this perspective of it, because especially, as you know, with our company, we deal with a lot of new investors, and we're happy to. But a lot of it is just changing your thinking and learning how to actually conceptualize and visualize these things and actually understand it. And a lot of it is just running through the numbers, and the numbers don't lie. So it's important to actually run through those calculators and see this is the whole idea. I mean, cash flow is important, yes, but the more experienced you become, cash flow is actually probably the least important thing when investing in real estate. We wanted to be positive, and cash flow is a tool that you can create your financial independence at some point in time. But the reality is, through all these other things of mitigation against inflation, debt reduction, using leverage as a tool to scale your portfolio, appreciation, tax benefits. I mean, all those things are what's going to allow you to really grow net worth, in my opinion. But Aaron,
the cash flow will come, guys. It will come. Even if it's not year 1, 2, 3, 4, 5, it will come by following the principles. And as you said, we work with the newer real estate investor. I love the newer real estate investor. Let me just give you one little nugget here. Good judgment comes from experience, and experience comes from bad judgment. Great way to learn on the playground in grade school. Not a good way to learn the real estate investment. Get together with people like ourselves. I'm going to put a little plug in here. I've been doing it since 97. These guys have got hundreds of deals, thousands of deals under their belt. Let us guide you with practical data, not speculation and theory. Don't go shopping around for something that's cheaper when in reality it's going to be a long-term expense.
Yeah, and it's like I tell people all the time, interest rate, literally the only thing it does is calculate your payment for the thing. So who cares if it's 7, 10, 2, 3%? It just gives you your payment, and that's reflected on your cash flow and those things. So, I mean, it's a number that everybody focuses on, but it's just one number that determines one thing, and one thing does not make or break real estate investments very often.
100%.
Aaron, where can
Appreciate you guys. Thank
people
you.
where can people find out more about you and reach out to you to get some lending quotes or just hear more of this excellent knowledge? I know you're putting out a lot of content on a regular basis as well.
The best place is aaronchapman.com or aaronbchapman.com, either one. Usually the B has to be used because the other one doesn't want to work on a certain computer. And if worst case, just Google me. There's like 4 of us out there that have any real space on Google. There's an English soccer player, a pastor, a author, and there's a bald-bearded redneck lender. I think you can figure out which one you're looking for.
I love that you know that the other Aaron Chapman's out there of who that.
Well, I like the fact that I pop up first in most cases. So I'm like, that's pretty good. And I've only been on the internet in reality, putting a website out of any consequence and getting on Facebook and all other bull crap because of my marketing guys since 2017. So you've got guys that have been doing this for years, and I'm like, bam, right there really, really quickly. It happened in the first year getting on there because of the traction to my site with people trying to learn about investment, real estate, and finance. That's beyond what they're getting from anybody else. Nobody talks about these things because it's hard. No other lender discusses this crap because it's a lot of mental labor to get this all figured out and then put out something twice a week, giving people information on the market, how it affects them as a real estate investor.
Yeah, I will say get on Aaron's mailing list. He puts out, like he said, videos once or twice a week. I watch them on a pretty regular basis. They're if not good information, then good stories about what's going on in his life. So highly recommend.
I'm distracting, right?
Yeah. So, I mean, everybody's got, let's see. Would you rather spend 8 or 9 minutes actually learning something or 8 or 9 minutes watching, some random TV show? So his are more valuable over the long run. So that's aaronbchapman.com. At least that's the one that I have bookmarked. aaronbchapman.com. You can find us at renttoretirement.com. If you forget Aaron's website, you can also contact us through there. We'll get you in touch with them. Happy to do it. You can find us at renttoretirement.com, see our inventory, see all of our team members. Happy to have a consultation with you to discuss how we can help you get where you want to be in your real estate journey. Don't forget to leave us a review on your favorite podcast platform. Really appreciate all of you who have taken the time to do that. And if you have any questions, don't hesitate to reach out. That's podcast@renttoretirement.com. That's podcast@renttoretirement.com. And we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.